The high dollar is making life difficult for Australia's biggest listed oil refiner, Caltex. Its margins have been squeezed, leading to a 24% drop in its first half profit, adding to speculation it could stop refining here altogether. Michael Vincent reports.
Caltex is a company with a split personality. Its marketing arm or fuel sales are a success, but its refining business is causing it pain. Analysts aren't happy with its results.
On a historic basis, very, very weak. They've had huge issues in refining this year, and I think that's part of our issue with the company, is that you've got one half of the business, which is a phenomenally strong defensive earning marketing business, and then you've got refining, which is, to an extent, a basket case.
Caltex would like to focus on marketing.
Marketing, 17% EBIT uplift year on year, and that is a continuation of a 12% annual growth rate over the last 4 or 5 years, which is an excellent result.
Within that result, its sale of transport fuels increased 26%.
And we're seeing our premium Vortex diesel now represents just under half of our total retail diesel. And within the overall diesel sales, we see the commercial sales to mining resources and other industrial companies up a very healthy 13%.
But Caltex is now turning its mind to the costs of its refining business.
We have initiated a review to understand the role of refineries will play in maintaining continuity of supply to our customers. As part of a broader review of refining, we are considering the optimal operations of the 2 catalytic crackers at Kurnell.
The problem for Caltex has been the rise of the Australian dollar.
Yeah, so it's one of the huge structural issues for refining at the moment is that they have to effectively price what they sell to their marketing business on an import price parity.
What sort of impact then does the Australian dollar have on a company like Caltex?
Regional refining margins are set in US dollar terms, and therefore the Australian dollar margin is purely a byproduct of what the region dynamics suggest. So they effectively have to take what they're given from the region. So the Australian dollar has been a huge, huge impediment to them on that basis.
What do you think the strategy for the company would be then?
I think that the key to the entire investment case is their plans on what they do with refining. I mean, you've got a marketing business that, if you didn't have refining there, would be trading on a 12-month forward PE of 6 times. I mean, if someone told you they could buy Wesfarmers or Woolworths for 6 times PE, they would be knocking your door down.
Do you think they are going to close their Kurnell or Lytton refineries?
We've seen with Shell, recently they've announced that they're going to close their Clyde refinery in Sydney and turn that into an import terminal. It's not as easy to say Caltex will do that, but it's an option open to them to convert their refineries into import terminals, and you effectively remove that refining business from the valuation.
Caltex will pay an interim dividend of 17 cents a share, down from 30 cents a share for the same period last year.